Hello, good afternoon and welcome to Mutual Fund Corner on CNBC-TV18 and I'm Vinnii Motiwala in the Mumbai studio. Now, we've seen a recent volatility that's hit the equity markets, and because of that, passive funds have emerged as a beacon of stability for the investors. With inflows of 784 crores in December 2024, the segment has marked an incredible milestone. 50 consecutive months of passive positive flows that we're seeing coming in, and this is since October 2020. Now, adding to the momentum, a whopping 41.89 lakh new folios were added last month. That's the month of December. And this is taking the total folio count to an impressive 22.5 crores. But what is driving this growth? Is it going to sustain in this passive funds? Is the interest going to be there going forward? Is the appeal of a low cost or an investor is going to turn to passive as a more safer bet during uncertain times is something that we'll be discussing today in Mutual Fund Corner. And joining us to decode these trends, we have two distinguished experts. We have Nirav R Karkera, who's the head of research at Fisdom, as well as Kushal Bhagi, who's the owner of PCC Investing, joining in with us this afternoon. Very good afternoon, gentlemen, and thank you so much for joining with us. Let's dive into this most important topic that we're talking about today, given that the volatility that we're seeing. And today itself also we're seeing so much volatility in the market. Passive mutual funds have actually seen a significant inflow in the recent years. Do you think this is something that is driving to retail investors in this spectrum, especially coming in? What are you watching out for on this front? Kushal, good afternoon, and let me take it across to you first. What does this mean?
Yes, good afternoon to your viewers and good afternoon to yourself as well. So, passives have been surging the AUM, and it's not just in the last 1 year, but it's now been a trend over a few years, right? And these contributors have been both institutional as well as retail money. So if I talk about Insti first, the biggest change has been from the Insti side has been EPFO money. In 2015, they were permitted to invest 5% of their corpus in equities, and passives became a big beneficiary of that. That limit was then increased to 15% in 2017. So, big surge in flows, and along with NPS money, these have been big drivers towards the AUM of passives. Now we come to the retail part, which again is very interesting. We're all aware of the impact of online platforms. They've been able to attract huge number of retail customers. And part of their main messaging has been, why should you buy mutual funds from distributors? We make it so easy to buy it off our platform, and you can save on fees, which can be as high as 1%. And the math behind it, when you compound money over 25 years, has been communicated very effectively. So cost all of a sudden came into the limelight. And through investor awareness efforts, through messaging, one understood that index funds were even cheaper. So, now you're getting a really good price, a deal price-wise. The only question was that of performance, that by investing in passive products, are you leaving returns on the table? And the narrative over recent periods has been that active funds have found it hard to beat the benchmark. So, the idea of guaranteeing at least a lower cost, investing in simple products that, quite honestly, everyone wants to beat and people are finding it hard to beat, that proposition is appealing to Gen Z and millennial investors, and they are the ones who are driving the growth of retail passives.
Okay, Nirav, good afternoon, and let me take this question to you as well. What do you think is going to be driving, what is the driving force for the shift? And do you think it's actually a reflection of retail investors' skepticism towards these active funds that we're seeing?
Yeah, so a pleasure to be on the show. So talking about the retail investor behavior specifically, there is one massive behavior bias that has been pretty evident, especially in the recent past couple of years, and that is the recency bias. In fact, if you go through the past couple of SPIVA reports, there has been enough and more highlighting of the fact that passive funds have been outperforming active funds, and the narrow sort of rally that we have been witnessing in the markets over the past couple of years has led to passive counterparts showing much better shorter term performance across several segments, leading to investors believing that passives indeed outperform actives on a consistent basis. Now, now this is not an absolute fact. This is a perception, and also you have the narrative that has been imported from the West, right? With the more developed markets having a pretty robust, passive investing ecosystem. The retail investors here who are now far more aware and perhaps in certain segments overtly aware about development of the passive space seem to be taking a lot of preference in favor of passive investment options. So that's one. Apart from that, if you look at the kind of passive offerings that have been entering the market over the past couple of years, most of them are smart beta funds and factor slash multi-factor thematic based passive funds. So, while these are passive in nature by style, they offer investors a very distinct opportunity to take exposure to very, very distinct slices of the market, very distinct factors of the market, and to optimize their overall portfolio at a reasonably lower cost. Now, this opportunity is not offered by many active funds where you can probably calibrate your exposure basis a certain factor or a number of factors, right? So the advent of smart beta funds and factor-based funds has been a driving force.
Sure. Kushal, one important point that, I was noticing when I was seeing this is that active funds actually have historically, when you look at it, they've been able to beat the market in certain conditions specifically. Do you believe passive funds have the ability to actually and truly outperform over the long period of time? Or do you think the performance is just a result of some market averages that maybe you're looking at it?
Yeah, so actually Nirav made a point of it. In the global context, when you look at US markets, active funds have found it hard to beat passives consistently, and maybe it's a sign of a more mature market. I think in India, there seems to be a general consensus that there are still opportunities for active funds to make their mark. Now, a couple of observations with respect to which one outperforms and when, okay? Let's consider two market profiles. The first one being where few stocks contribute to most of the gains. The second one is a broad market rally. Now, in the first case, these are stocks that become darlings of the market. They get their own name. They are acronyms which are sort of named after them. FANG is an example. These are the most popular and influential American tech companies in the last decade. And even closer to home, your viewers would remember Hrithik. You've got HDFC Bank, Reliance, Infosys, TCS. These are examples of a few stocks that contributed disproportionately to the rise of the index. Even that then started to changing. From Hrithik, it became Bharat. And you had Bharti Airtel and Asian Paints, etc. come in. So I think the point is that active funds will find it very hard to outperform the benchmark if they don't have these stocks in meaningful weightages, because these are the ones that are actually moving the market. But in another market profile, like a broad market rally, like we've had in the recent past, actives tend to do better because there's more scope for them to pick stocks that are outperformers. So the performance will keep chopping and changing and will vary based on what the market profiles are.
Nirav, just furthermore in terms of, going to scratch your brain on this one, is your thoughts also coming in on active versus passive funds? Anything specific you would like to add to this?
Yeah, so I believe that the entire debate between active versus passive, and we use passive rather loosely to also incorporate index investing, right? So taking that into cognizance, I believe the roots of it can be traced back to something that we know as efficient market hypothesis. So, long story short, the more mature and the more efficient a market is, it will get increasingly difficult to outperform an index. However, having said that, considering the Indian markets and probably most other constituents that lie beyond, let's say, probably Nifty 100, is where the efficiency isn't probably as strong as it would be in most other developed markets. So that is where there will still be scope for active funds to outperform the index or a passive style of management. Of course, like Kushal said, whenever there's a narrow rally wherein there's an overweighted segment of constituents that start performing, of course, a portfolio with an underweight on such constituents will tend to lag. However, I believe a better way to look at it is by slicing the listed universe into market cap segments that are pretty efficiently covered, and where there is a very limited information anomaly and other types of anomaly, and the pricing is far more effective. So so barring Nifty 100, there is good reason to believe there is still scope for bottom up stock picking and ability to generate active performance through active share, through selection, allocation, and timing, which may not be as much possible in the top Nifty 100, wherein a passive strategy could probably hold over, actively managed portfolios.
Okay. That's the word coming in terms of performance as both active versus passive funds. But, Kushal, what I want to understand, does it always merit that because passive has lower expense ratio, does it always translate to better returns coming in? And especially considering taxes, transaction cost, is that something of a sort of a thing that one should watch out for, that better returns because of these lower ratios or lower expense ratios?
The lower expense ratios of passive funds is just a start, right? It means that active funds have to outperform by that much more to be on the same level. And to assess whether they're capable or not, it's again something that Nirav referred to. It could be worth understanding the playing field of the investable universe, whether it allows for outperformance. Look, you have to be very different from an index to outperform, right? If you're index hugging, you're going to get index type returns. So in large caps, it is considered harder to generate alpha because the portfolios tend to be more homogeneous. You've got 100 companies. You have to invest 80% of it in those top 100 companies. So portfolios can have a similar look and feel. But if you look at mid and small caps, the universe is bigger, 150 and 250 stocks. And the requirement today is that only 65% has to be invested in this universe. So schemes can have a very different look and feel to each other. So even though expense ratios in mid and small caps can be higher because there's more work of fund management, right? You're tracking so many more companies, but the scope for outperformance is much higher as well.
Okay. Nirav, what I want to understand also is passive funds normally track indices, right? Like we were mentioning before as well. But they come with some bit of a risk. So how do they perform during market downturns? What are we watching out for there? Is there anything specific of a risk that one should watch out for?
So passive funds that typically mirror an index, let's assume this is a passive fund wherein the mandate is to specifically track and mirror an index. We call it one beta portfolio. That is, it has the exact same degree of sensitivity to a market that the market has. So for instance, if the index that it is tracking goes up by 10%, the fund will also go up by grossly 10% and the other way around, right? So by virtue of that, the kind of risk involved in such index-based passive strategies is very similar to that that is contained within the respective indices. So this is also called a systemic risk. So most such passive strategies typically tend to have a high exposure to systemic risk, and there is very little scope for unsystematic risk to get into play here. But also one thing I would say that is the risk that helps in delivering the performance. So both active funds and passive funds make money through volatility, and volatility is a key feature of risk. When we talk about risk from a broader perspective, right? So the risk involved in index-based strategies could be much more amplified whenever the broader market or the benchmark or the index that it is tracking starts exhibiting a higher degree of volatility. If that's not the case, in most cases, especially in less concentrated indices and well-diversified indices, the risk typically tends to be much lesser than actively managed counterparts, wherein there is a whole lot more of an unsystematic risk also that comes into play. So while there is a risk, it is slightly lesser than most comparable actively managed portfolios.
Right. Kushal, while obviously passive funds are more popular for their set it, forget it kind of an approach, can retail investors still benefit from active fund managers during this volatile market?
Well, theoretically, yes. But, the actions of the fund manager must also pay off. And that doesn't always happen. The truth is, it's impossible to consistently predict the better outcome between active and passive. And I'll give you an example of how hard it is to switch between funds. As of December 2020, as the market recovered from COVID, you can see that passive funds have delivered significantly better return than active funds. We've taken two funds HDFC Nifty 50 and HDFC Large Cap, which was earlier HDFC Top 100. And 1 year, 3 year, and 5 year, you can see that their returns are significantly higher. So it corroborates the narrative that passive was superior, at least in the large cap space. Okay, and a lot of interest was generated in passive funds. But if we forward to December 2024, and there's been a broad-based rally recently, you'll see even due to their higher cost structure, the performance of active funds is now very superior, right? So at the end, we must understand that active fund managers will do better in some profiles, passives will do better in the others, and it's a reality that we have to live with. No point trying to switch between one and the other. It normally doesn't work out.
Okay, on that note, we're going to slip into a very quick break. On the other side, we'll continue with our discussion on our passive funds and how they react in a volatile market. What are we watching out for there? So stay tuned in.
It's been over 2 decades of tracking the global power shifts at the World Economic Forum. Starting from our first story reported 20 years ago to last year's groundbreaking coverage of the world's most important economic event. From discovering era-defining ideas to connecting you with the world's visionary thinkers and doers. From decoding blueprints for growth to driving collaboration to make a better future. We've been bringing you a wealth of information through 20 seasons. Tune in to Davos Diaries at Davos 2025, live and exclusive on India's most trusted business news platform, CNBC-TV18. From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. It's been over 2 decades of tracking the global power shifts at the World Economic Forum. Starting from our first story reported 20 years ago to last year's groundbreaking coverage of the world's most important economic event. From discovering era-defining ideas.
Good afternoon and welcome back to Mutual Fund Corner on CNBC TV18. We still have our experts join with us, Nirav as well as Kushal, who are talking to us about the passive funds in this volatile market. What should we be doing, and should one continue to have a higher mix towards passive, active? What is the strategy there? That's what we'll talk about now. Let's keep it going, gentlemen. And what I want to know is it now the right time that a retail investor should switch from an active to a passive fund, or should they continue to rely on active managers and maybe maintain a mix between both an active as well as a passive fund? Kushal, let me take it to you first.
Yeah, look, investors do tend to chop and change their portfolio frequently. You ditch a scheme if the recent performance has been below par in favor of the best performing fund. And I'm not a big fan of chopping and changing too much, and we've just seen an example of why. So my guidance is that you have to take real extra care while constructing your portfolio. Pick 5 or 6 schemes, which represents all caps, and the ratio can be in line with your risk tolerance. and it includes hybrid funds as well. And investors must understand the role that each scheme plays in their portfolio and then stick to that. Practice risk management concepts like rebalancing, bucketing, do regular reviews. And now some investors will prefer the appeal that passives provide, the other will prefer active funds, and both are really fine. I think the game is not which one to select or predict which one will do better. The game is, can you invest aggressively and remain invested in equities for long periods? And to do that, a do-it-yourself investor must upgrade their knowledge because eventually they have to be confident about managing large corpuses, right? Or the other alternative is that you look to work with an MFT or an advisor, which is what a lot of HNIs and ultra HNIs do, because the stakes of making big mistakes with big money is quite high.
Right. Nirav, taking the question to you as well, which is adding on to a point, while what would your advice be right now in terms of active versus passive or a mix? And do you think passive funds are signaling a paradigm shift in investing, or does active management still have a future going forward?
So passive investing is clearly innovating at an amazing pace already. So passive investing is no longer just the simple, straightforward vanilla index investing that we used to know passive investing for. So like I also mentioned earlier in our conversation, that passive funds now also encapsulates a variety of passive strategies, which could include factorial investing, multifactorial investing. In fact, there are a few thematic passive investing options that are available. And now coming to think of it, isn't there a little bit of active and passive as well? So passive also is basically a portfolio or a fund that has a set number of underlyings, which is rebalanced and reconstituted from time to time based on a certain set of rules, right? So it is also being actively managed. So the idea is to take exposure to the underlying set of stocks, one, and two, having conviction in the rebalancing / reconstitution methodology, right? So if you look at funds and investing portfolios, investment portfolios, as a sum total of its aggregate underlying holdings and the rules that govern what those holdings are going to be, life is going to be much more simpler in terms of deciding whether to go for an active fund or a passive fund. And I feel another important question that investors must always ask before selecting a fund, and it is not whether it should be whether it is a passive fund or an active fund. Instead, it should be whether this fund solves a specific purpose, or is there a certain objective that the investor is trying to achieve with this particular fund. Now, whether it turns out to be a passive proposition or an active proposition is largely a byproduct of this earlier decision, right? So that's happening. And of course, having said that, given the pace of innovation in the passive proposition also, and the fact that the lines between active and passive is slowly and gradually blurring away, we can expect to see a lot more uptake in funds that are conventionally categorized as passive funds.
Absolutely. Lines are blurring away. But Kushal, I want to take this point forward. Do you think passive funds can actually provide same level of diversification and personalization as an active strategy then, if the lines are blurring down now?
Yeah, but see, it's proper. I think passive funds are known to be less flexible than their active counterparts. But I think, as we've mentioned in the show, there have been so many developments in the passive space that, they are trying to broaden their appeal and overcome certain inherent limitations. So smart beta, whether it's factor investing, a quick example. Many index funds are weighted by market cap, right? Means the larger companies dominate the portfolio. So the top 5 stocks in the Nifty, for example, constitute more than 34% of the weightage. So their performance has a big impact on the performance of the Nifty. Now, one innovation was, let's have an equal weighted portfolio. So you've got 50 scripts. Each of them have a 2% equal weight. So, if market cap weighted indices were a bother, now investors have an alternative. As Nirav has been mentioning, broad market indices like Nifty 50, Next 50 is sort of given way to passive strategies based on factors, whether single factor, multi-factor, like your value, you've got growth, low volatility, momentum. And this has got the appeal of investors in the last year and a half or so, where, you can choose the type of factor based on your assessment of market conditions. If markets are very choppy, you can go in for a low volatility fund. Markets are trending, you can go strictly with momentum funds, which I think out of all the factors has done the best so far. So price-wise, they might be a little bit more expensive than your traditional pure passives, but definitely cheaper than pure active funds. And yes, I think you can expect to see a lot more innovation going forward.
Okay, Kushal, as well as Nirav, thank you so much for joining in with us on the show, because that's all the time we have today on Mutual Fund Corner. Viewers, thank you so much for tuning in, but don't go anywhere. More action on the other side.